Are you a startup owner who's looking to get funded? Or are you an investor who wants to find his niche? Regardless of your position, you should know what types of investors there are. In this video, we're going to analyze 5 types of startup investors, but before we start, don't forget to subscribe to my channel and click the notification bell so you're always first to learn how to invest and make money. Although we frequently hear of intrepid individuals funding startups with their own wealth and earnings through the bootstrapping strategy, this strategy is sometimes unrealistic or impossible. More frequently, fledgling businesses must seek investors to help fund their projects. 5 common types of startup investors include banks, angel investors, peer-to-peer lenders, venture capitalists, personal investors. Typically, these investors' funds are used to launch a new product, expand operations, and upgrade equipment and supplies. Before reaching out to any investor, companies must take legal precautions, as each circumstance is unique. Banks. Some small businesses obtain bank loans to assist with initial expenses. The 2007 mortgage crisis has made it more difficult to qualify for a bank loan. It is advantageous to have personal experience in the industry or a knowledgeable mentor in the industry. It may be necessary for businesses to provide collateral, such as a home equity loan, and as much startup capital as possible. Typically, the bank requires a detailed business plan that includes a thorough and exhaustive description of the business, a description of the core products and or services of the business, financial projections, management projections, plans for objective accomplishment. You will also be required to demonstrate financial responsibility. Start with a bank with which you have an existing business relationship for the best results. You should also investigate Small Business Administration Guaranteed Loans, SBA. This agency guarantees loans for partners, including banks and other conventional and unconventional lenders. Due to the fact that these loans are guaranteed, it may be easier for startups to qualify. SBA loan programs consist of SEVNA Loan Program, Microloan Program, 504 Loan Program. The SEVNA Loan Program is intended for businesses working with a small or rural lender, implementing pollution control measures, or affected by NAFTA. For working capital, purchasing supplies or inventory, furnishing a location, or purchasing equipment or machinery, microloans can be up to $50,000. Microloans cannot be used to pay off existing debts or purchase real estate that has already been acquired. The 504 Loan Program, administered by certified development companies, assists startups in expanding operations or bringing them up to date through the purchase of buildings or land, the improvement of buildings or land, the construction or modernization of facilities, the renovation of existing facilities, the purchase of machinery, and the refinancing of debt. According to the SBA, these loans are financed 40% by the SBA and 50% by the lender, and a 10% down payment is required. Angel investors. An estimated 268,100 angel investors invest an estimated $20 billion annually in 60,000 companies in the United States. The average amount invested of this type is $74,955. Angel investors are typically wealthy entrepreneurs who wish to leverage their wealth by investing in projects they are passionate about, particularly startups that may have difficulty gaining access to more conventional sources of funding. Numerous angel investors are successful entrepreneurs, corporate executives, and business professionals. Typically, this investment takes the form of a loan or stock purchase. Occasionally, they also mentor or advise the company in which they invest. Some angel investors, for instance, specialize in a particular type of company, such as new technologies. In some instances, these angels make a high-risk investment with the expectation of a large return if the company is acquired by a larger corporation or goes public. Typically, this category of angel investor is most active when the economy is robust or stable. If an angel investor has approached you or you're considering approaching one, ask the following questions. Do you anticipate authority in exchange for your investment? Moreover, how much? What is your driving force? What is your professional experience? Does our startup meet your requirements? In a promissory note, the terms of a loan from an angel investor are specified. Angel groups allow angel investors to pool their funds for larger investments. In 2012, the Angel Resource Institute database listed 385 such organizations in the United States. Peer-to-peer lending. With peer-to-peer lending, startups and entrepreneurs can create online profiles for their projects on websites such as Prosper and Lending Club in order to attract investors' attention. These services aim to connect small business owners directly with entrepreneurs, eliminating the middleman. The SBA advises startups interested in peer-to-peer lending to create a business plan and company history that details their progress and major accomplishments, as well as the results of market research, industry analysis, and financial projections. You should also be willing to disclose how much you have already invested. The objective is to demonstrate to prospective lenders that your company has what it takes to earn money and be successful. Possible investors in peer-to-peer loans will have access to your credit history. In some instances, lenders will require you to improve your credit score prior to loan approval. After approval, you will negotiate the investment's interest rate with the lender, who is typically a private individual. It is essential to comprehend the loan's terms and avoid falling behind on payments. This can result in higher interest rates and ineligibility for future loans of this type. Additionally, businesses should familiarize themselves with state regulations regarding peer-to-peer lending. Venture capitalists. In 2012, a total of $22 billion was invested by 465 active venture capital firms in the United States. The average investment in each company is $2,600,000, which is more than any other type of investment. Typically, venture capitalists invest in only 1 out of every 100 deals they see, compared to about 1 out of 10 for angel investors. In addition, they conduct extensive due diligence, which can take up to 5 months for each investment. Venture capitalists invest millions of dollars in a company in exchange for an equity stake, also known as equity capital. The investment is premised on the belief that the value of the equity capital will increase over time, resulting in a return on the initial investment. Typically, this type of investor works with companies that have a solid business plan and have already demonstrated some level of success. You must demonstrate a solid business plan and high profit margin. Rarely do venture capitalists invest in high-risk startups. When business owners invest with a venture capitalist, they relinquish a portion of the company's ownership. Some venture capitalists will want to weigh in on managerial decisions. You will also likely pay this investor a higher ROI than you would for a conventional business loan. Consider establishing a detailed partnership agreement that outlines the rights and expectations of each party when working with a venture capitalist. While venture capitalists occasionally serve as mentors, they are typically more involved in operations. When seeking venture capital opportunities, it is optimal to receive a referral from a common acquaintance. For instance, you can ask existing investors to share your business with their networks in order to expand your funding opportunities. Individual investors. Although you may not have considered asking family and friends to invest in your startup, this is a common strategy. In fact, personal investors represent a larger portion of the pie than any other type of funding source, investing an average of $23,000 per project and contributing over $66 billion annually. This strategy is best suited for funds to launch a new business. However, loyalty and affinity for the business open the door to potential long-term investments for private investors. Personal investments, according to CNN Money, should be governed by a contract just like any other type of investment. This may prevent the inherent risk associated with mixing business and family. Ensure that your familial relationships are strong enough to be kept separate from your business relationships. For instance, if the venture is unsuccessful, you could harm your loved one's finances as well as your own. Sign a promissory note outlining the terms of the loan and a separate agreement if a partnership is being considered. Investor types that entrepreneurs should avoid. All investors are not created equal, so it is essential to examine potential investors with the same vigilance that investors employ when evaluating startup opportunities. Examine the lending institution's track record, values, and management style. Keep in mind that you are entering into a long-term relationship, which should not be entered into lightly. Certain types of investors seek to exploit inexperienced business owners. Avoid investors who also engage in frequent litigation. If they believe you lack the financial resources to fight them in court, they may resort to intimidation to gain more control and more money after you invest. Similarly, avoid investors who want you to sign a lengthy contract containing obscure clauses that can be used to their advantage. Avoid imperial investors who attempt to take control of all of the company's strategic decisions. Some coaching and mentoring is beneficial, but constant supervision is not. Be wary of those who call themselves investors but lack the financial resources to invest in your business, as well as those who lack business acumen. Occasionally, these individuals attempt to profit from finder's fees without contributing their own funds. In fact, perform due diligence on all fee-charging investors. How to find the appropriate investor. Instead of passively waiting for investors to approach your business, you should actively network with investors in your industry niche by engaging in business conversations and attending networking events. Emails and cold calls are typically ineffective. Instead of passively accepting the investor's term sheet, develop your own term sheet outlining the investment terms that make sense for your business before approaching investors. Legal counsel from a reliable source is indispensable throughout the investment process. Clients as investors. In 2013, more than $51 billion was raised through customer-focused crowdfunding campaigns. Each company that used this method to raise capital received approximately $7,000 in investments. Using a strategic marketing campaign, a startup relies on support and donations from personal and professional networks for crowdfunding. This strategy is ideal for social media-savvy businesses as returns increase dramatically in proportion to Facebook and other site shares. The greater the number of direct links to a crowdfunding campaign, the more successful it will be. Therefore, it is essential to encourage contributors to share the campaign with their own networks. The majority of crowdfunders are between the ages of 24 and 35. Men earning more than $100,000 per year are the most ardent supporters of these campaigns. 3 categories of investors. Each investor has unique characteristics and desired outcomes. The first type, the buy low, sell high investor, is typically a short-lived investor because emotional decisions lead to poor investments. The index investor seeks passive management, aiming for average performance with good results in good markets and less than stellar results in poor markets. Value investing investors invest more capital in bargains and less in assets with a high market value. Typically, entrepreneurs who have the time to manage their investments will be successful. If you want to learn more, don't forget to subscribe to my channel and click the notification bell so you're the first to see my new videos.